We start off today with a presentation by Ong Ziyang, Senior Macroeconomic Analyst from iFAST Financial Singapore. We've also opened up the first poll for the day, ladies and gentlemen, so please do send in your responses. Over to you, Ziyang. Welcome.
Hi, good afternoon, ladies and gentlemen. Thank you for taking your time out of your schedule to join us here for our investment webinar today. I'm Ziyang, a senior macro analyst with iFAST Singapore. And today, I would like to take some time to zone in deeper into the emerging market, a segment of the equity market which we feel most optimistic about this year. I think to start, we can take a look at the performance of the emerging market last year. You can see that despite being beaten down quite badly during the COVID sell-off in March and sort of lagging in recovery compared to the developed market like US and Europe across the middle of the year, the picture actually started to look a lot better and a lot brighter than the rest of the world looking into the later part of 2020. In fact, in the earlier part of this year is when we are starting to see a lot of this outperformance in the emerging market. And we think that moving ahead, this outperformance will continue to persist. I think we believe that 2021 will sort of mark a global reflationary environment where the economic growth starts to recover post-COVID, the COVID's recessionary environment. It's also important to note that a lot of this 2020 economic contraction last year is mainly attributed to the COVID pandemic. And as we're speaking, the mass vaccination programs that is sort of rolling out across the world could potentially accelerate a lot of this growth rebound that we expect to see. And I think growth rebound after any recession, if you take reference to the past crises like the Great Financial Crisis in 2008, the growth rebound tend to be very strong after a recession, and usually often above the historical trend. So looking ahead, we can expect that the same situation will start materializing for the world this year as well as next year. I think it's also important to note that there's a lot of pent-up demand, a lot of discretionary spending that could be unleashed back to the market once things start to improve COVID-wise. I think, yep. So with this, we also think that earnings will start to improve massively this year. If you look at it in terms of the EM market, because of the cyclical exposure towards a lot of the beaten down sector. So a lot of transient factors, such as a lot of temporary factors of your short-term decline in last year, as well as the year before, results in a very low base effect, where a lot of your EM markets like your Latin America, your Asia emerging market, provide them with actually a very low bar to clear. So looking ahead, we think that the cyclical earnings per share recovery will be pretty significant and will be a very key driver for the EM equities. I think looking ahead in this global reflationary trade, a lot of the by sector, you can see that within the emerging market, all the way from Brazil to your Turkey, a huge component actually ties in with your financials, your energy, your consumer discretionary. And a lot of these sectors and companies were the one that was beaten down really badly during the COVID pandemic. A lot of your financials actually went down on 20 to 30% kind of drawdown. Your energy players were actually down by almost more than 50%. And not because of that, I think this low base effect, we're going to see the EM being able, the tables will start turning around for a lot of these EM. And based on the sectorial mix, because of this cyclical tilt towards this more cyclical sector, more economically sensitive ones, the sort of the global rebound post-COVID will be will be expressed the most impactfully within the EM. And I think there's actually quite a few macro tailwinds that are supporting the EM equities. Firstly, I think the US dollar have been heading downwards, have been contracting in terms of strength for a while. And we expect this, and if you look at it in the past, 30, 40 years, you can see that the US dollar strength actually moved in terms of a cycle. And moving ahead, we can expect that the dollar weakness to continue ahead. I think not just because, I think one of the key most near factor would be that the Federal Reserve, the central bank in the US, will continue to print more money to using their quantitative easing to help boost its economic growth or support its growth at this point of time. I think the chairman, Powell, actually came out to reassure the market participants that a lot of this supportive measure remains to be something that they are looking at and will be willing to deploy them whenever they think is necessary. And one of the key thing about the dollar weakness is that it's actually very supportive for EM equities. You can see based on the trend for the last 20 years that every time the dollar weakened, EM equities actually appreciate very sharply in price. So in this dollar bear market, we think that it will actually provide a very strong base for EM equity to outperform that of the DM market. And I think one of the key reasons why is because a lot of your EM markets actually hold dollar denominated debt. So when your dollar start to weaken vis-a-vis a lot of the local currency, the EM currencies like your real, your renminbi, is that a lot of these EM countries can actually be able to pay off their financing costs a lot easier and actually improve their sort of profit margin in the long run at this point of time. So at the same time, the second factor that we see that's actually driving the EM equity is actually the rising commodity prices. If you have been following the news frequently recently, you have seen that copper prices, iron ore prices are hitting multi-year high, near decades high. And I think this is to show that it's sort of an early signal that the world is starting to recover. A lot of factory activities are starting to pick back up. And not only that, a lot of governments that are using fiscal policies to kind of stimulate their economy are going through a lot of infrastructure building, which means that they'll require a lot more of this basic matter, a lot of fuel to kind of boost your economic growth. And the good thing about that is that your EM equities, especially your LATAM, your EMEA, your Asia, like even ASEAN, is that a lot of these economies are fundamentally commodity exporters. So because of these rising prices, it was going to be a very, very big boost for your EM equities as a result. I think your commodity prices, I think not just in terms of, because as an EM, the EM equity is sort of a proxy towards the global growth. That's not just on a sentiment side. In fact, in terms of fundamentals, when your commodity prices improve, because of how cyclically tilted a lot of your EM indexes are positioned towards, the rising commodity prices actually help fundamentally boost corporate earnings. If you've seen over the last 15 to 20 years, it's actually a very, very close correlation. Whenever commodity prices start to pick up, earnings actually start to pick up. So right now, I think there's a lot of concerns that equities all around the world are kind of at an overheated valuation level. But when your earnings are starting to pick back up, your expensive valuations aren't going to look that expensive anymore. And in fact, versus the DM, EM is still trading at actually quite a substantial discount in terms of valuation. So there's a lot of positive catalysts lining up for EM this year. And I think to zone in a little bit deeper, we are actually quite favorable on Asian EM. I think one of the, a special mention goes to South Korea, which actually done pretty well for this entire, in fact, from the start of 2020 all the way to this year. In fact, in terms of a single market performance, it's up about 40%, a lot better than the rest of the other markets. And it has to do with a lot of your tech and your tech and electronic kind of exports. I think the sort of this tech-heavy market actually recorded the exports actually started to pick up quite strongly. And looking ahead, we actually think that this will continue to be a main driver for the South Korean equities. Right now, if you've been following the news, you've seen that the global chip shortage is something that is plaguing the entire industry. In fact, the auto industry, and South Korea, being one of the key components is Samsung Electronics, actually one of the leading foundries that is capable of producing a lot of these semiconductor chips. And looking ahead with this chip shortage, we think that not only are these chip exporters being able to export even more chips, they are actually started to raise prices on a lot of your chip components, like your DRAM prices, your NAND, your A6 chips are all starting to pick back up from the later part of last year all the way to the start of this year. And we think that this trend is starting to move even more strongly ahead, especially when the rest of the world in terms of economic growth starting to pick back up. I think in terms of key trends, we think that say your 5G upgrade cycle in terms of a smartphone, your Bitcoin mining rush with the fact that Bitcoin is actually up more than 60 to 70% year to date are key drivers for a lot of your semiconductor chips. And I think in terms of outside of Asia, we are actually quite favorable on your Latin America as well as your EMEA. So in Latin America, we think Brazil is quite a good spot. Firstly, performance is actually quite lagging versus the rest of the EM. And a lot of the commodities are actually your metal, your iron ores are all coming up from Brazil, this region. Of course, at this point of time, there's a lot of idiosyncratic factor that is weighing it down. But we are over the longer term, maybe 1 to 2 years out, we think that Brazil can actually start to pick back up very strongly and be able to realize about a 30 to 40% gain in terms of performance. So I think the other market that we are quite big on right now is actually Russia. Russia is actually a big winner for the higher oil prices. So the upside, we think that earnings revision has been actually quite aggressive downwards for this market for a while already, and this earnings revision could potentially move towards a more positive end given these higher energy prices. At the same time, it's also one of the EM that provide one of the highest dividends percentage, around 3 to 4% across the rest of the world. So while waiting for the prices to pick back up, investors are actually compensated with your high dividends use. I think, yeah, so this actually wrap up my presentation. Overall, for 2021, we think that this is actually a global reflationary environment and economic growth to start to pick back up. Although there's a bit of concern right now in terms of valuation, and you're seeing markets selling down because of the rising 10-year bond yields. We think that this is probably just going to be a very short-term adjustment. And looking ahead, EM is well positioned to take advantage of sort of the global economic growth. And we think that investors who are looking to kind of position themselves to the future needs to include more and more EM into their portfolios right now. And in fact, any kind of dip or any kind of correction within the market could be actually a good opportunity to accumulate a bit more exposure into your Asia EM, your Latin America EM, as well as your EMEA kind of region, selected few markets that will benefit from sort of the commodity rush, your economic reflationary environment looking ahead. With that, I've come to the end of my session. Thank you for your attention.
Thank you so much for your insights, Zian.